Greetings, everybody. Even though it might be too late for us now, since we're already in late September and the Fed has already hiked us up to 3.08%, I'd like to share for future reference and for future years, if we ever go through a Fed rate hiking cycle again, what I think might be a good way to prepare our portfolios to profit from it. If you're wondering why I didn't make this video sooner, such as before the rate hikes even began, it's because I never knew that Fed rate hikes were a thing until going through this bear market and reading headline after headline talking about yields going up and then finally doing some research. I've only been buying and selling stocks for 2 years, and so this is all a learning experience. Anyway, let's get to the findings and the hypothesis. So what we're looking at here is a 5-year chart of the federal funds rates, which is what the news and the Federal Reserve refer to when they talk about rate hikes. As you can see, we were near 0% on the funds rate for almost 2 years before the Fed finally decided to raise rates and cause the stock market to crash. Now let's compare this chart to the 10-year Treasury yield chart. As a side note, however, some people may wonder why I chose the 10-year when we also hear a lot about the 2-year and the 30-year yields. Well, when I was doing research on Treasury yield ETFs, the one I found that to me had the best return to date with the least volatility over the past 5 or more years was PST, which corresponds to the 10-year. To demonstrate what I've just said, let's look at the comparisons between the Treasury yield ETFs. In the past year, many of the other Treasury yield ETFs have actually done better than PST. PST is the light blue line, which looks like the 3rd highest line, but it's actually the 4th. But if we take a longer term view, such as 5 years, we see that PST is now the highest performer, being one of only 2 of those ETFs that managed to stay positive. Meanwhile, the other ETFs that outperformed PST in the past 1 year are actually down by up to negative 30% over the past 5 years. I'm not saying that the other ETFs are not good options to some extent. They obviously did wonderfully during the past year. But for a longer term perspective, I'm using PST as the example. Now back to the purpose of this video. This comparison between the funds rate and the 10-year yield isn't perfect, but you can notice trends, the peaks and valleys between the federal funds rate and the 10-year Treasury yield during the past 5 years. There was a mountain for almost 3 years, then a lull for 2 years, and then the skyrocketing of raising interest rates and yields this year. So my point is that during the lull, it might have been a good idea to buy PST or other Treasury yield ETFs while they were low. Now I know we can't tell the future, but once we become aware of the existence of the federal funds rates and look at their history, such as this 10-year chart, it might seem evident that the funds rates couldn't stay near 0% forever. As you can see, the rates were low from late 2012 until late 2016 before they really started picking up. And that could be one of the drawbacks of this strategy. That is, once the yields go back down again, and if we decide to buy an ETF like PST, we may have to wait years before seeing a significant return. And so some investors may rightly say that their money is better put to use in other assets such as stocks, which will probably be rising and paying dividends, meanwhile the PST stays close to doing nothing. This year, PST is up 33%. Meanwhile, the Nasdaq is down negative 30%, and the S&P 500 and Dow Jones have been hovering around bear market territory. But we would have had to have prepared for it when the rates were low and waited up to a year for the PST to take off. Whether or not that's something you'd like to do and prepare for when the rates go down again is up to you. And of course, I can't guarantee that this is always going to work, but based off the observations and research you've seen in this video, this is what I've come up with.